Good morning, everybody, and welcome to your weekly Ask Our CIO session from Nutmeg, a regular webcast to keep you updated on what's been going on in the markets and what we at Nutmeg have been doing about it. My name is George Mitten, investment writer here at Nutmeg. In a minute, I'll introduce our CIO, that's our Chief Investment Officer, James McManus, who'll give us a short presentation of about 10 or 15 minutes, giving us some context to what's been going on in the markets lately. And also today, he's going to be talking a bit about ETFs, exchange traded funds, and why we think they're such a useful investment, especially at a time like this. After the presentation, we'll have our Q&A session. We've still got some questions left over from last week's Q&A that we didn't have time for, so I'll be covering some of those as well as some of the ones that have come in since we sent out the invitation to today's webcast. And of course, please do submit a question using the Q&A feature here on Zoom while James is talking, and we'll try to cover that too. If we don't have time today, I'll put it on the list for next week. Just to let you know, this webcast is being recorded and will be available to watch again if you like. You'll also be able to share the link with friends or contacts. Many of our viewers today are Nutmeg customers, welcome, but we understand that some of the people tuning in are not yet and are currently seeking information about us and our investment strategy. If you're in that group, welcome. If you've indicated that you'd like to know more about us, my colleague Cully Samra will be happy to chat to you more directly in the next few days. One more announcement. Many of you will be well aware that we are edging tantalizingly close to the end of the tax year, which is on the 5th of April. So that's Sunday, 4 days from now. If you're planning to make a contribution to your Nutmeg account before the end of the tax year to make the most of your ISA or pension allowances, for example, then it's really worth acting on that as soon as possible to make sure the money will be received by us before the deadline. That's enough from me. I'll now introduce James. In case you hadn't guessed, like many businesses in the UK, Nutmeg is currently working remotely, so James and I are not in the same room. Okay, over to you, James.
Thanks, George, and thanks to everybody listening for joining, and as always for all of the questions that you've submitted in advance. I hope you are all safe and well wherever you're listening to this webcast. As George mentioned, we're currently operating Nutmeg remotely, so I'm hosting this webcast from my kitchen table where my office desk has been transplanted. Here's what we intend to cover in this week's webcast. I thought it would be useful to briefly provide an update on financial market performance for the full month of March. If you're a keen observer of markets, you will have noted that the past week or so has been much brighter for markets in terms of returns. And then we'll go on to look at a number of interesting charts before moving to talk about ETFs and addressing a topic there that we received a number of questions on last week. And then, of course, afterwards we'll move on to answer as many questions from you as possible. So firstly, an update on market performance. And here I've updated the chart from last week showing market performance for the month of March 2020 for a range of financial assets plotted against the long-term volatility of those assets. So as a reminder, the further right you are on the x-axis, that's the horizontal axis, the higher the volatility over the long term. And the further towards the top of the y-axis, the vertical axis, the higher the performance over the long term. So higher the performance in the month of March. So firstly, much like last week, despite the respite in market losses over the previous sort of 5 to 7 trading days, it's been notable in March that it's produced very few assets with a positive return. So just US and UK government bonds produced very small positive returns, whilst gold made a late move into positive territory, having delivered losses for the month up until last Monday. But overall, most asset classes delivered returns in March that were relatively well aligned with their long-term risk profile. That is, the riskier assets, such as emerging markets, small cap equities, assets that we expect to have higher volatility over the long term, delivered the largest losses, whilst developed market government bonds lived up to their safe haven reputation, delivering slightly positive returns with lower long-term volatility. As always, there are a number of outliers. You'll notice in the chart here, both Swiss and Japanese equities delivered lower losses than their equity counterparts with similar long-term risk profiles. Both of those equity markets have currencies that are often considered in the safe haven category, Swiss francs and Japanese yen. But again, what really stands out to me from this chart, and I do need to caveat that it's a very short time period, is the value of diversification. The points plotted in green here show the performance of a number of Nutmeg fully managed portfolios over this period. And what we can see over the full month is that even the funds with significant equity exposure between 80 to 100% over the long term have delivered much lower losses than individual equity markets. And the principle of diversification, again, is all about spreading risk across a broad range of asset classes, across different currencies, across countries, across sector exposures, on the premise that different assets perform differently at different times. And albeit over a short period, again, I think this really demonstrates the value of the diversification in a multi-asset portfolio in volatile market environments, rather than investing in single markets or single stocks. Now, many of you will have noticed over that the losses in this chart are not as extreme as in the chart we showed you last week. And in fact, we've seen over the past week a rally in many riskier asset classes as investors have begun to digest the improving situation in Asia in terms of the medical outcomes and the ability of the Chinese economy to start to normalize, and the heavy stimulus injection that we've seen in developed markets. And that's really helped to quell market panic. So on slide 5, I've picked out a number of core asset classes, and I've split their performance by the first 3 weeks of the month and the final week or so, the final 7 days, just to demonstrate the improvement that we saw last week. And in fact, we saw one of the strongest weeks last week for global equity markets since the global financial crisis. And now bear in mind, if you lose 10%, you need to make more than that to get back to your starting point. So these percentages demonstrate growth from a lower value in the final days of the month. But it's another good example of why discipline pays in investing. Sticking with the market, not making changes to your risk level, allows you to participate in the market rebounds when they occur. So does a turnaround in markets last week mean that we see light at the end of the tunnel? Well, we maintain we're still in a quite critical stage. There are reasons to be really encouraged by the magnitude of policy actions that have taken place, but the medical response remains the most critical at present to really understanding the length of the disruption and what that means in terms of the shape of the recovery. And it's worth noting also that in other crisis periods, performance of markets just simply isn't linear. Rallies in riskier assets like equities are common even within the most volatile crisis periods. So to give you an example, between September and December in 2008, the US stock market had 6 individual rallies of over 9%, one rally as large as 19% in that period. But the stock market didn't bottom until March 2009. So reasons to be optimistic, but also reasons to be cautious on the outlook from here near term. So given market returns, where do we stand from a volatility perspective? Recovery from the extremes of those market losses has been accompanied by a fall in volatility from the extremes. And you may remember last week I showed you a chart of the US stock market volatility as measured by an index called the VIX. And that had recently breached the levels that we'd witnessed in the global financial crisis. And I talked about volatility rarely remaining elevated for long periods of time. And in fact, what we've begun to see is volatility start to fall. Now, it's worth noting it's still at levels far in excess of its long-term historical average, but the fear and the panic in markets has begun to dissipate. Investors have begun to digest what the changes we've been through in the last 5 weeks mean in terms of the current operating environment, and investors have been comforted by the significant level of stimulus that's been pumped into the global economy by governments and by central banks across the world. So, does falling volatility mean that the worst is over? Well, again, it doesn't mean that markets can't fall further from here or move lower from here. But what it does tell us is that, the peaks of investor fear and panic, the irrationality that really drives the most volatile moves in markets, is now subdued relative to where it was a week or so ago. And that's a positive thing to take forward. Now, in last week's webcast, I also talked about volatility referencing the day-to-day moves and the extent to which these can be larger than we typically experience over the long run, but both good and bad. And in terms of day-to-day moves, March has truly been a historic month. But I also talked about why it's important not to focus on only the negative days when markets are volatile, and to recognize that volatility means sharper movements up and down within any given period, and thus trying to time the market in that short term becomes quite a futile exercise. And this chart really demonstrates this, I think. Again, using the US stock market as a proxy, but it's a similar story across many other developed market stock markets. And you can see how the magnitude of daily markets has increased. So, behaviorally, people tend to want to reduce risk when they experience losses. But what this chart shows you is that actually riding out the volatility is the best way to reduce your loss. There are clearly no guarantees that good days will follow bad. But what we do see is some coincidence in the occurrence of good days and bad days. And that actually, if you were to crystallize a loss after any given bad day, actually you're crystallizing a loss at a point where you are more likely to experience a sharp volatile move upwards in the immediate term. So a couple more charts I've picked out on topics that are front of mind this week, and the first is of the pound sterling GBP, and the pound historically doesn't perform well in strong risk-off markets. It didn't perform well in the global financial crisis, but what we've seen sterling do is drift significantly lower over recent weeks, and now on a trade-weighted basis, sterling is back to its historical lows. In fact, it's lower than the levels we reached after the 2016 EU referendum, and that feels very low. And we increasingly think that Brexit looks like it might be heading for another delay. The rhetoric continues to be that the deadline will be held, but given the likely economic trajectory in the UK, it's going to be really tough for the government to be able to ensure businesses are dedicating resources and planning for a potentially abrupt departure of the EU, should that be the case. And that really might make the case for a further delay. And even as does even a tighter and more unrealistic timeline to conclude negotiations and ratify a deal from here to the end of the year. So we'll be watching GBP very closely. Again, it has drifted lower to a level there, which is really quite low on its historical basis. Slide 9 gives you an indication that the oil price has continued to drift lower, and the disagreement between OPEC partners and the decision by Saudi Arabia to ramp up production at the beginning of March that led to that initial leg down in oil prices is looking somewhat short-sighted, I think, at present. The demand for oil has now fallen significantly globally, given the lockdowns that are in place. And therefore, the world faces an oversupply of crude oil, and that's meaning even more pressure on the oil price. Again, the trajectory of the disease and the shape of the recovery is going to matter a lot here. We could see some fundamental changes to the supply side of the oil industry if prices remain this low for an extended period. We are back to the bottoms of 2003, 2002 prices now, and that likely is going to make the economics of some supply side factors of the oil industry quite unattractive in the near term, and the longer that lockdowns and this sort of economic clouds build, then the more we might see the supply side disrupted in the oil industry in a way that's more meaningful than just near term. And then the final chart here is another historic figure for the month of March, and this really points to the fact that we're beginning to see the macroeconomic effects of the action that has been taken to curtail the spread of coronavirus start to come through in some of the high frequency data points. And you can see in the chart, this is a chart of weekly jobless claims data in the US. So this is the weekly initial jobless claims that are filed in the US. And last week, this came through at a record 3.2 million claims. And you can see in the chart what a departure this is from the levels we've seen historically. Even during crisis periods such as the global financial crisis, it peaked at around 700,000 initial jobless claims in a week. So a huge volume of claims last week, and I think this really speaks to the magnitude of what is going on in the underlying economy, given the sudden stop nature of the economic shock that we're experiencing. And it also helps explain why policymakers have been so proactive in implementing policy. And we're now starting to see forecasts that suggest unemployment might peak at levels above the past crises. So in 2008, and 2009, the global financial crisis, unemployment in the US reached around 10%. And we're starting to see forecasts that suggest we could see materially higher unemployment levels than that. So this is going to be a really critical data point to monitor in coming weeks. And again, it's another reason to remain relatively cautious at the moment until we have better sight of what is going on with companies and the jobs market in the economy. So last week we got a number of questions on ETFs, and I wanted to just spend a couple of minutes talking about how ETFs have performed in this period of market volatility. Because of the growth of the ETF industry, there are always headlines about ETFs. In fact, the degree to which they have disrupted the sort of traditional stock picking businesses means that they're often a target for criticism, which in the most part we don't believe is fair. However, it is fair to say the last couple of weeks has been, amongst the ETF industry's biggest tests. ETF products have gained significant assets since 2008. And so this period of market volatility has been a really good asset test for the market and for the ETF ecosystem. So I thought quickly, just a first reminder about why we like to use ETFs in our portfolios. So in our opinion, ETFs are one of the investment industry's best kept secrets. They've been truly transformational in their impact on the asset management industry. So ETFs resemble traditional mutual funds. However, they trade throughout the day on the stock exchange, and they differ in a number of key ways to mutual funds. And that means that they offer, in our opinion, greater choice, greater flexibility, and greater transparency. So ETFs have really democratized asset allocation. They've provided access to asset classes that simply weren't accessible to many investors before, and in much more efficient ways. If you think of an example here of physical gold and how difficult it would be as an individual investor to be able to not only just afford physical gold in a full gold bar, but also store and insure that and ensure its security. ETFs offer a really simple and efficient way to gain exposure to that asset class. But they also maximize our ability to offer diversification. As you will have heard us say before, the average Nutmeg portfolio is around 8,000 underlying securities. It allows us to offer greater diversification at a much lower investment minimum and a much lower cost. They offer greater transparency in terms of the holdings, but that's also in transparency in terms of risk and transparency in terms of costs. And ETFs aren't passive. What we like to describe them as rules-based. They're methodical, if you like. Behind every ETF is a rules-based methodology, and they're methodology driven. They're consistent. We know what we're going to get from them, and we can rely on that consistency because we know that they rely on a rules-based framework. But they also give us a great choice and flexibility in how and when we access asset classes. They allow us to be very discreet or very broad, or to take risk and to manage risk in portfolios. But ETFs overall give us, better liquidity at a lower cost in a more flexible way, and also with fewer capacity limitations. So we're not restricted on how much we can invest in a market, because the underlying fund can grow as the assets in the underlying fund grow, and as funds commit into the fund itself, the fund can grow. And because it's accessing broad underlying stock markets, there are less issues with the capacity and the strategy. Now, if you're a keen reader of the financial news at the moment, you may have been reading about ETFs, and in particular, you may have heard about the concept of premiums and discounts. So I just want to take a quick moment to explain this, because there are often some misconceptions around this. So ETFs essentially have two valuations. There's the net asset value, and that is the total per share value of all the securities that are held by the ETF, and that's set on the closing price of the market or the index. And there's also the market price, and that's the price at which market participants are willing to buy and sell the ETF shares. And the two, net asset value and market price, often differ, and they differ for a number of reasons. That can be supply and demand. It could be the impact of timing. It could be the costs associated with creating and redeeming the ETF units if the underlying market dynamics change. And I think this is particularly prevalent in fixed income assets. So it's really important to understand that net asset values, those closing prices at which securities are valued at the index level, can be stale, they can be old. And I'll give you two examples of this. The first is when we buy a strategy in London that is based on an index that is based on a market that is outside of UK or European market hours. So, for example, US Treasuries. Now, the London ETF will be set at the closing price of the London Stock Exchange. But the net asset value for the index will be set at the closing price of the US stock market. Now, there's a timing difference between those two, and that can drive then differences between the price and the net asset value if the market were to move in US trading hours once the US UK market was closed. But in fixed income, we also see these discounts and premiums occur because bonds tend to trade less than frequently than equities. So bonds aren't exchange driven. They don't trade on an exchange throughout the day. Bonds tend to be buy and hold investments, and therefore the price at which bonds are valued tends to be based on the last price that they were traded, which could have been yesterday or a couple of days prior. So the ETF price at any point is reflecting an up-to-date value for that basket of securities. It's providing a real-time price, if you like, for what somebody is willing to buy and sell those securities at. And that's why we see those discounts and premiums open up between where things have last traded and where they're trading now. But I think the key critical thing here really is to understand that how these discounts and premiums are governed. And ETF prices will reflect the dynamics of underlying assets. So if the cost of trading underlying assets increases, the cost of trading the bond market or the equity markets increases, then the cost of trading the ETF will likely increase as well. But it's really important to understand that premiums and discounts are limited by an effect called arbitrage, and that is the ability to make risk-free profits. So, for example, if a fund was trading at a 5% discount, if the securities in that fund were actually worth more than that, then the easiest thing that anybody could do would be to break up the ETF, to take the underlying securities and to sell them for more than they are worth. Arbitrage governs the price of how ETFs move, because it means that there is no risk-free profit at any point. So how do we account for this at Nutmeg? Well, I think it's really important to understand we use both proprietary technology, but also human expertise to reduce our trading costs and to really focus on and dedicate a lot of resource to how we maximize the benefits of ETFs. So this means, trading smartly. The European market is fragmented, the ETF market. That means that liquidity is split across various stock exchanges in different locations, not just in London, but also in Milan, in Switzerland, in Frankfurt, etc. And we've really focused on economies of scale. So we bulk our clients' trades together. We execute them with specialist market makers in order to gain better prices. And we also utilize a proprietary fractional technology that allows us to buy fractions of ETF shares that controls the risk in your portfolio, but it also allows your money to get working harder for you quicker. You're not reliant on buying whole shares. We can buy portions of shares for you. And that means no matter what your wealth level is, we're able to get your money working harder. So the table on the right, under the green column, shows you the average spread that we pay for a range of ETFs in our portfolios when we buy and sell. And the column on the far right shows you the average exchange spread for those. So that's the average spread you would pay if you traded on the stock exchange. And you can see the difference there is pretty significant in the way that we trade for our customers. We're achieving much better prices, and in fact, we've saved over 4.5 million in bid-ask spread in trading costs for our customers since we started managing portfolios in 2012. So I wanted to finish on a further example of discipline when investing and not losing sight of the long term. And I think this is a topic that came up several times last week about whether you should continue to contribute when markets have fallen. And my answer at the time was, if your goals and your time frame haven't changed, then the best thing you can do, the best discipline you can show, is to continue as normal. And I also spoke about the behavioral biases that can influence that behavior, the emotional aspects that make it hard to continue to contribute or to maintain your risk level when you've experienced a loss. And so I've tried to create an example here that shows you just how damaging a loss of discipline can be in the long term for your investment goals. And in this example, we're taking a 30-year-old with a £5,000 pension, and at the current time, who's contributing about £400 a month. Now, we're assuming that individual holds off making contributions for the next 6 months. They're allowing their emotions to influence their behavior. And they're going to hold off making those contributions to see how markets recover. And that might seem like a smart thing to do in the short term, It is, how, after all, only missed contributions of around £2,400. But that really forgets one thing. It forgets that returns compound over time. And in fact, compound is one of the most powerful forces that you can have on your side when investing. And its effects are often misunderstood, or widely misunderstood. So, to illustrate this, assuming at a retirement age of 65, generous now, possibly if you're 30, but those missed contributions of £2,400 today translate to a difference in pension value of around £13,000 at retirement. So significantly more than you might expect, and an example of why discipline really pays in the long term, and why it makes sense to maintain your investment discipline in volatile markets. And I think we'll stop there, George, and move to questions, because we're a little bit over time on the presentation.
No problem. Thank you, James. I mean, very interesting slides as always. I was struck by a couple of those. The US jobless claims is really a sort of once in a lifetime kind of chart, isn't it? That's really remarkable. But also, I was struck by the scale of the market rebound that we've seen. As a sort of vaguely engaged investor, I was conscious that markets had picked up quite a bit in the last week or so, but actually seeing quite the extent of that rebound was really quite impressive, and made me very glad that I did what you always say we should do, which is that I stayed invested rather than selling out at the bottom. But anyway, that's enough about me. So it's time for the Q&A session. Thanks again to everyone for the questions that you sent in. We had another really good response in advance of this webcast. Of course, some people have posed questions on similar topics, so I won't necessarily answer every question, but hopefully the topic you asked about will be covered. Charlotte has touched on an issue that many of us are concerned about. That is the likely onset of a recession. She wants to know what kind of recession we can expect. And I quote, "I've read that some economists are predicting a V-shaped recession, while others are more cautiously considering a flattened curve. What do you think is more likely, and what are the indicators to look for in each case?" James.
So, good question. I think it's a tricky one to answer from a purely economic perspective, because the answer will really depend on the medical trajectory of the virus. And when we talk about a V-shaped recovery, what we talk about is, essentially a V-shaped recovery means a relatively short recession followed by a strong recovery. So, and that is certainly possible, but it depends on the successful containment of the coronavirus. The effective stimulus of the economy in the meantime to keep businesses going and keep people employed. And if the virus can be contained and the economy can be supported in the near term, then the economic recovery can begin when containment measures are loosened, and therefore V-shape is perfectly possible. We've seen some encouraging signs of Chinese activity data starting to rebound, which supports this more positive view. But those signs of recovery in China have occurred because of the really tough actions by the authorities there to limit the spread of the virus. And I think in other countries and populations where they're potentially not either willing or able to impose those same kind of limitations on personal movement, we need to be careful about comparing China to those. And China's a useful benchmark, but we just need to be very aware of the differences in approach. And there's some fantastic studies of how effective China has been in curtailing the spread, and some of the technology they've used to do that. So quite clearly where we stand today, the virus is not yet contained in Europe or the US or, indeed many other countries. And I think in much of the world, the number of infections and deaths is still going to continue rising in the near term. And it's hard to forecast when that will be brought under control, and not least because the testing rates differ from country to country. And so normalizing this data set can be quite difficult for an appropriate comparison. So we're really at a critical stage. Effective containment, as we said before, is really the first step. Clearly, there are both optimistic and pessimistic views on the timeline for that. As I mentioned before, I think it depends on the steps taken to contain the virus. And here again, we're seeing a different approach in different nations. If we see extensions to the containment, as it seems is becoming the case now in Italy and Spain, then clearly the economic damage will be a little bit greater because of the secondary effects. Those are the feedback effects in the economy from the continued shutdown. But I think also in this instance, we're likely to see more stimulus. But that would mean a likely flattening of that recovery curve from a V into a U. And I think what we can say definitively right now is that the stimulus measures from governments across the world have been unprecedented, that they have the potential to provide a significant tailwind to the global economy once the virus is under control. So if we work to the current timeframes and are optimistic about how quickly we can contain this, how quickly we can pull back the social distancing measures, then certainly a V-shaped recovery is something that is possible. I would be looking at some of the high frequency data, weekly jobless claims, some of the data coming out of China and South Korea to try and understand how quickly economies can be normalized.
Thank you, James. Yes, let's hope for a V, but perhaps prepare ourselves in case that doesn't happen. But Barry here has a good question about bonds. He says, as my pots are mostly 4 or 5 out of 10 on the risk scale, I assume that means Barry has either a fully managed or a socially responsible portfolio. He says, given that they're at that risk level, my portfolio is mostly exposed to the government bond market. Can you expand a little on how you see this market performing in the next couple of years?
Yeah, sure. Another really good question, actually. And a lot of media coverage on the recent market moves is really focused on drawdowns in stock markets rather than focusing what's been going on in the bond market. The vast majority of Nutmeg customers have an allocation to government bonds in their portfolios. So naturally, the performance of that market is going to have an influence on your returns, both in the short term, but also in the long term. I think firstly, if you've watched last week's webcast, government bonds, especially US Treasuries, have performed relatively well in the recent equity sell-offs. That confirms what we have long held the view that government bonds are a very useful safe haven investment, that they're very useful for offering diversification in the riskiest market environments, despite their now lower yields. When other assets are falling in value, investors always want to own treasuries. Treasuries remain one of the lowest risk investments available in terms of investors' perception in a risky, volatile market, and that I think will mean that treasuries will continue to perform in volatile in markets. Looking at the medium term, what we'd expect from government bonds, especially treasuries and to some extent gilts, is to always form part of investment portfolios despite their lower return expectations. Yields on government bonds are towards their all-time lows, but that's not surprising given the unprecedented situation we face. And so the returns are potentially meaningfully lower going forward than they have been historically. But because bond yields are so low and the prices work inversely to yields, that is, if yields rise, then that means prices fall and losses for bondholders. This is something we're acutely aware of, and especially given the level of fiscal spending that we're seeing in developed market economies. We do think it's likely we'll see yield curve control in the US. That's when the Fed will target levels of yields to sort of limit the degree to which yields can rise. And we do think we're in a lower for longer environment for bond yields and interest rates. And this will limit that risk to some degree, but it still presents a risk to capital, the idea of bond prices rising, bond prices falling and yields rising. But I think government bonds have, they've really shown that they still offer value from a diversification perspective. We know that market downturns and recoveries are far from linear. And so we think bonds still retain a place in portfolios from a diversification perspective. But one of the reasons we're holding more cash than usual at the moment is precisely that bonds do appear relatively expensive on a historical basis, given that they're towards their lows in yields and that those potential returns are lower going forward than they have been historically.
Thank you, James. Difficult to talk about bonds without getting into the technical side, but thanks for explaining that in a way that I was just about able to understand. Here's a question looking at Nutmeg's trading system, and Owen has asked this, but we've had a number of questions both for the webcast and our customer support representatives have had questions about this. It's about our trading cycle. So the question is, in light of the unprecedented volatility in the markets at present, do you have any plans to increase the frequency of your trading? That's the frequency at which Nutmeg trades in the market, James.
So we typically trade twice a week. We do this for a variety of reasons. In essence, it's there to help us trade as efficiently as possible and help lower the effect that those bid-ask spreads, those transaction costs in the market have on our customers' funds. Our trading day really depends on the days when market conditions are supportive. And we reserve the right to be able to trade more often than twice a week if we think is necessary. So, for example, for the investment team, when we want to make changes, we have the ability to do so on any given day of the week. So we do have the ability to trade more than twice a week if we want to. Generally, we think twice a week is most appropriate because it's the most cost-efficient way to trade. We try to ensure that trading days coincide with cash flows. For example, many people are paid in the UK on the same days each month, and therefore many contributions to Nutmeg accounts will arrive at similar times, and therefore we might tailor the day that we trade in a given week to try and capture as many of those as possible. From a customer perspective, I appreciate there might be or appear to be some time lag between investing and withdrawing money and the trade being actioned. I think Nutmeg is an investment service that was built around long-term investing, and ideally, we recommend investors stay with us for at least 3 years. And that's in some ways how we have to see our trading cycle in that perspective. We're investing for years, not days. We will, as I said, we have the ability to trade more often if we need to. But as a discretionary manager, we believe that twice a week is most appropriate at the moment.
Thank you, James. Okay, we have a rather punchy question here from Pablo, who's obviously been listening quite carefully to the investment team's communications recently. He says, in the current market conditions, you have reduced the level of risk in the fully managed and socially responsible portfolios. Does this not contradict your advice to Nutmeg customers not to reduce the risk level themselves? Does it mean that we as customers should increase our risk level? Otherwise, he says, it might take longer to recover from the current losses once market conditions improve. Bit of a tricky one for you there. What's your thoughts, James?
Well, firstly, I don't see it as a contradiction. I think we encourage customers to set goals for the long and medium term and to not change their risk levels unless those investment goals or their investment horizons have changed. And that's really considered to be good investment discipline. If you're investing for long term, that means staying invested through ups and downs, and that gives you the best chance of reaching your investment goals. What we do as an investment team is different. So Nutmeg is a discretionary investment manager. That means we make investment decisions on your behalf if you're in a fully managed or socially responsible portfolio. If you have a fixed allocation portfolio, your asset allocation is set and then rebalanced automatically. But as an investment team, what we're looking to do is position our portfolios appropriately for the balance of risk and reward based on what we judge the prevailing macroeconomic and market outlook to be. And we consider a wide range of data inputs in order to form those views. And that includes more fundamentally based inputs that look at things like cyclical macroeconomic analysis, the geopolitical trends, thematic research. We also look at market technical inputs, the asset valuation metrics, how others are positioned, and investor flow analysis, what the price dynamics and market expectations are. And then we also have a quantitative input that looks at regime analysis and behavioral analysis, and looks at topics like correlation of assets, risk appetite, and the crowding in investment markets. And we then use a diverse range of asset classes to build robust portfolios that really seek to benefit from returns across the economic cycle, while managing risk to what we deem to be acceptable levels. And we don't seek to trade portfolios. So rather than trading the portfolios themselves, we're managing the investment strategy with a medium-term view that reflects the balance of risk and reward, given the outlook. And as you mentioned, we did reduce risk at the beginning of March in many of our fully managed and socially responsible portfolios. We did that because we were taking a cautious view about the spread of the virus and the unprecedented actions that were being taken to curtail it. and the economic impacts that those would likely occur over the medium term, not just the market impact in the short term. And I think it's really worth noting here that this isn't just about reducing risk. Simply doesn't mean just selling equity markets, for example. It also means repositioning portfolios for the medium term outlook. And so, for example, one of the changes we've made in Nutmeg portfolios in March is to reduce our exposure to smaller companies in the US and Europe, and they're businesses that typically tend to underperform, tend to struggle in recessionary environments, and we've allocated more to large cap technology companies that we think at the moment are better positioned because they've got broadly stronger balance sheets, higher cash allocations, and they've got a higher share of recurring revenues in their business model. A similar example would be as reducing risk in high yield bonds. So it's not just about reducing risk at a total level, but thinking about the mix of risk in the portfolios and whether that's appropriate for the new economic reality in the medium term.
Thank you, James. Really interesting topics. We've had some good questions in, but I've just seen the time, and James has to get back to work. So I think, unless you're very, very keen to answer another question, James, I better end it here. But if your question hasn't been answered today, you can take one more. Okay, James is going to take one more. Let's do it. Okay, we've got another one about ETFs, which is, I think, pertinent, given that you talked a bit about ETFs in your presentation, James. This one comes from Paul. How safe are ETFs if there is a severe financial meltdown? How liquid are they in the event of a severe crisis, James?
So I think ETFs have performed really well in this period of market volatility. They've accounted for large portions of trading volumes in recent weeks, so they've really demonstrated their liquidity attributes in times of stress. ETFs in the US market typically account for around 20% of trading volumes in a given week. But what we've seen during the record, what we've seen is record trading volumes in ETFs in March, and on the busiest days, ETFs have accounted for more than a third of all stock market trading volumes, and that's really significant because they're a much smaller portion of the market than that in terms of ownership. So I think when we talk about liquidity is the ability to obtain fair prices for securities in stressed markets. The ability to buy and sell securities. And I think what ETFs have proved in March, even through some of the most volatile market periods we've witnessed in history, that they have retained those liquidity attributes. As I said in the webcast, there have been a number of press articles focusing on fixed income ETFs and the dynamics of how they price, and in particular trading at what's known as a discount. That's when the price is lower than the net asset value of the fund. Again, there are some quirks there around timing, but I think it's really also important to understand that ETFs are a reflection of the underlying asset classes as well, and where we've seen significant dislocations or significant volatility in the underlying assets, ETFs have acted as a real-time price, and there is no real-time price for bonds. As I said before, they're not exchange traded. The prices are set through last trading values when they've been last marked to market, and therefore those prices can be stale. So ETFs are offering us a real-time price. They're offering us the liquidity, but they will reflect the performance of the underlying securities markets. And so if high yield bonds are stressed, then high yield bond ETFs will reflect that in their performance. As I said, arbitrage should limit the amount that ETFs can trade at a discount. If the price was lower than their value, you could simply break up the ETF for its underlying bonds or its securities and make a profit. Arbitrage really governs that relationship. This is something, as I said, we spend a lot of time looking at. We think ETFs have performed relatively well in this period, but we will continue to study ETF markets, the trends that we're seeing in terms of liquidity, and using all of those liquidity partners that we have and the expertise that we have in-house to really inform our views on that topic.
Thank you very much, James. As I said, there are some other great questions that have come in, and we will answer those, but it'll have to be next week, I'm afraid. So if your question didn't get answered today, please do tune in, same time next week, 11 a.m. on Wednesday, and we'll try to cover it then. I just want to reiterate, we had a couple of questions on the chat feature that this video will be posted to YouTube quite soon after this webcast finishes. So if you didn't catch all of it, or if you want to watch it again, you just need to go to the Nutmeg channel on YouTube. You should be able to find it if you search for Nutmeg YouTube. All our videos are there, and this one will be added to our video channel, so you can watch it again. We've had some really positive feedback on these webcasts. If you've reached out to us with kind words lately, thank you very much. It really is appreciated. If you have some positive words to share about Nutmeg more generally, one way to do that is by leaving a review of us on the consumer review service Trustpilot. You can do that by searching for Nutmeg Trustpilot and writing a review. Not only is this really helpful feedback for us, but it could help other customers and potential customers on their investment journey too. I also wanted to highlight that our partnership with Great Ormond Street Hospital Children's Charity is still ongoing. At this difficult time, medical charities need all the help they can get. Great Ormond Street Hospital Children's Charity relies on people's generosity to make a real difference to seriously ill children and young people who need specialist treatment. We're donating £25 for every new Nutmeg Junior ISA account opened, and we'll also match any donations you make up to £100. You can learn more about this at nutmeg.com/JISA. Thank you once again for tuning in. We hope to see many of you next week, same time, same place.